Hello and welcome to the latest edition of The Exchange, brought to you by the New York Stock Exchange. I'm Douglas Jonas, your host, joined today by Kevin Kelly, founder and CEO of Kelly ETFs. As a reminder, today's interview is for informational purposes only. The NYSE does not recommend investments or investment strategies. Kevin, thanks for being here.
Thanks for having me.
Now, you've certainly been in the ETF business for quite some time. We've known each other a long time. Tell us about this latest venture, Kelly ETFs.
Kelly ETFs was founded and its mission is to bring cutting edge ETFs with really superior construction underneath of the underlying strategies. And so we founded the company because the whole premise is we think that there's archaic classification systems as well as artificial intelligence algorithms that really aren't capturing the true exposure that a lot of investors want. And so when we craft our strategies, we actually handcraft them with a deep understanding of the forces and factors that are really driving the thematic trends as well as the disruptive industries. So when we take a step back and look at the strategies that are being provided to investors, we're trying to provide the highly liquid, pure play, best-in-class companies for those underlying strategies. And we don't care about geographic location at all. So, we just want to provide you with that actual exposure.
Now, of course, you've got the Kelly Residential and Apartment Real Estate ETF, RESI, listed here at the New York Stock Exchange. Can you tell us a little bit about the strategy and where you think performance might be in this sector?
Yeah, so with the RESI ETF, we're providing exposure to the apartment and residential sector. And so that sector is really classified by 4 subsectors. And so the first sector is apartments. The second sector is single family residential, which is a newer subsector in the real estate space, as well as manufactured housing and student housing. And so if investors are looking to get a pure play way into the residential and apartment sector, it's a great pathway into those 4 subsectors. And so if we look at those subsectors, there's really been a lot of demand, especially in a post-COVID world. A lot of people are working from home. And another thing that's happening is household formation is getting stronger. And so you have 2 really thematic demographic drivers into this sector. And that's with the underbuilding that has happened for about 10 years, as well as household formation. So you have a strong runway over the next 5, 10, 15 years for these sectors, these subsectors to grow. And so we're really excited by it. And if you look at the companies within this ETF, they actually have unique competitive advantages because they've been around for a very long time. So first and foremost, they have scale, which is important if you're trying to provide a really strong residential experience. Second of all, they have the local expertise. They've worked with state and local municipalities for tons of years. And so when those municipalities are growing, they actually rely heavily on the management teams. And then third is one of their competitive advantages is they've been investing in technology for a very, very long time. And so if you think about the single family residential sector, it's a newer sector that has been primarily dominated by mom and pops. So less than 1% of single family homes are actually owned by institutional operators, constituents within our ETF. And so they have a long way to grow, but they also have the scale and technology to provide a superior customer experience because of the technology that they're able to embed, whether it's smart home systems or just the client experience with their portals and paying rent or looking for new homes if you're looking to move cities.
So Kevin, obviously a lot of real estate mutual funds are out there. What differentiates this ETF?
Well, the strong part about this ETF goes back to why Kelly ETFs exists, and that's to get the pure exposure you're looking for. So if you go out and you're looking for a residential ETF or mutual fund or any other type of product, a lot of times you're getting cross-pollination with other subsectors within real estate. So some ETFs or mutual funds that are residential actually have self-storage, they have healthcare. And so they're not giving you the pure exposure to those 4 subsectors that I had mentioned. And so you could actually get 20 to 30% into different subsectors that have different risk and reward opportunities that are different than residential. So the nice aspect is that this gives you the pure play exposure into that. And if you're an institutional investor, or if you're an allocator, that's exactly what you want when you're constructing portfolios. You want pure play, and this ETF provides that.
Now, of course, before I let you go, you also have the Kelly Hotel and Lodging Sector ETF, ticker symbol HOTL, easy to remember. Could you tell us a little bit about this one?
Yeah, so what's great about this one is it provides exposure to really the 3 subsectors within the hotel and lodging space, right? And first and foremost is those really servicing companies that we know, like a Marriott. And so Marriott actually a lot of times doesn't own the hotel. And so that's the other subsector, which is the hotel REITs, which actually own the hotels. And then the service providers like a Hilton or a Marriott actually get about 10% servicing fees. And then the last aspect is really sort of the timeshare aspect within the hotel and lodging sector. And so when you take a step back and you look at what HOTL is giving you, it's giving you exposure to the entire differentiated sector and all the key players that specialize in those sectors. So that's the nice aspect, is a specialization where they can add value. And they've got great balance sheets to capitalize on a rebounding consumer that is really, really looking to travel. And we're starting to see those trends go, and you're starting to see pricing really tick up. And that hasn't incorporated the biggest side of the business, which is business travel. So we're starting to see business travel and conventions starting to pick up. And so that's why HOTL is going to be a great bellwether of the economy, because it's going to capture 2 fundamental underpinnings of the economy, and that's the consumer and business. And so when you think about the traditional ways to look at the economy, you want to look at the transports. Well, we think this is a better differentiated play because you're capturing business and the consumer, whether it's leisure travel, which is already picking up, or business travel. And one thing about business travel, Doug, that I think investors should really note is that work at home is actually pushing and driving demand in the hotel and lodging sector, because as people start to work from home more, there's a lot of more off-site trainings that are happening within the hotel and lodging space. So it's actually creating a new subsector of demand, which is pretty interesting.
That is interesting. And, we see you a lot on TV. You're talking a lot about the markets. Of course, one of the biggest headlines is the idea of this rising interest rate environment. How do we think about that, and at the same time think about where real estate belongs in a portfolio?
Yeah, and so rising interest rates certainly are a concern a lot for real estate investors, and that's why not all real estate's created equal, and you need to focus on the sectors within real estate that can succeed in a rising interest rate environment. And so you want to focus on the sectors where the rents rise more than rates. And so we believe RESI as well as hotel provide that exposure, because rates are rising because the economy is picking up. And when the economy is picking up, the rates aren't going to rise as fast as the rents because there's too much demand. So we know there's secular and thematic demand behind residential and apartment. And so that's the nice aspect behind that. And then we know when the economy is picking up, business is picking up a lot more. And so overnight rates for hotels are going to pick up. And so I think the other thing that investors need to take into consideration is that these are great alternatives to fixed income, right? As well as the overall equity markets, because real estate tends to have lower volatility than the equity markets. And it's a great diversification tool because it has the stability of cash flows because of the recurring cash flows of rents coming in every single day and month.
So if you caught this episode live and you're looking for more ETF educational content, you can find it on our website, homeofetfs.com. That is homeofetfs.com, brought to you by the New York Stock Exchange, the home of ETFs.